Many people invest in the stock market by investing in mutual funds because they were told it's a good way to invest. In today's mini training, I will tell you why I don't like to use mutual funds. Grow your wealth, live on your terms. Hi, I'm Millen Livis, Financial Independence Mentor. I help professional women become financially independent faster than they believed possible, so they don't have to worry about money anymore. Cool? Okay, today I want to tell you why I don't like to use mutual funds as my financial instrument for investing in the stock market. However, to talk about this important topic, let's start with the definition of what mutual funds are. Okay, what mutual funds are. A mutual fund is an actively managed investment fund that pulls money from many investors like you and me to purchase a basket of securities such as stocks, bonds, commodities, money market instruments, or other similar assets, just like you would have a basket with vegetables, basket with fruits, basket with nuts, etc., right? Mutual funds are traded on the stock market exchanges, but not in real time, unlike stocks. In other words, the mutual fund's daily price is determined by its closing price at the end of a trade day. Different from stocks, right? Mutual funds are operated by professional money managers who invest the fund's capital with an intention to produce capital appreciation, and some mutual funds also produce income for the fund's investors. A specific mutual fund portfolio is structured to match the investment objectives of the fund that are stated in fund's prospectus. Okay, so every mutual fund has a fund's prospectus that you can review. Before I tell you why I don't like to use mutual funds, I want to tell you why many people actually bought into this idea of investing using mutual funds, because it must be some logic behind this, right? One of the main advantages of mutual funds is that they give individual investors like you and me access to professionally managed, diversified portfolio of equities or bonds or other securities. Each shareholder participates proportionally in the gain or loss of the fund. Now, running a mutual fund involves a few costs, right? Because we have a management team. Cost could be like investment advisory fees, marketing, distribution expenses, transaction costs, etc. Obviously, mutual funds pass these costs over to investors like you and me. Funds typically pay their operating expenses out of fund assets, which means that investors pay these costs. Traditionally, high fees are considered to be the main disadvantages of mutual funds investing. Now, that was the accurate and politically correct brief overview of mutual funds. Now, let me tell you my personal opinion. Most mutual funds are bad. And so today I will tell you why banks are biased when they sell you mutual funds, why most mutual funds are bad investment vehicle in my opinion, why you are giving away a lot of money when you use mutual funds. Let's start with the first point. Banks are biased about where they want you to put your money. You work for a corporation. You have a retirement plan. In the US, it's 401k that offers you specific investment options to choose from. Supposedly, these options are great for you. For the most part, they're not. And by the way, usually it's only mutual funds that you can choose from, usually. Another scenario would be you walk into your bank, your friendly neighborhood bank, and you tell them that you want to start investing, and they sit you down with a special advisor who is a smooth salesperson and this advisor convinces you to buy into one of the bank's funds. In both scenarios, they often say that the mutual fund has performed well and the fees sound pretty low. You trust your bank advisor. Until 20 years later or so, you add up the numbers and you see that the deal wasn't that amazing after all. What happened, you ask? What happened? You trusted your bank. There is one big flaw in the recommendations that they give you. Your money is managed by someone at the bank. They recommend a special mutual fund because the bank gets to charge fees to manage your money. And while this may sound reasonable, it really is bad for you. So let me tell you why most mutual funds are bad for you. Let's take two different mutual funds. One that charges 2% per year in fees, fairly common number, and one that charges 0.1% per year, also achievable value. The way the fees work is that every year that fee gets deducted from your investment regardless of how the investment performed. Okay? Regardless. Obviously, if you pay a higher fee, you'll end up with less money. What is not so obvious is how big this effect really is. Because every year you pay some percentage, for example, 2% of your entire investment, not just return on your investment. Okay? Let me illustrate this with numbers, so just bear with me. Let's assume a normal investment will earn 7% per year, which is considered the average return from the stock market over a long period of time. Then after 20 years, your initial investment of 100,000 should leave you with about 380,000. However, if you subtract fees of 2% from the amount that you invest and 2% annual fee, your mutual fund's outcome drops from 380,000 to 260,000. It's a significant drop, right? It's a drop that basically shows you that you're losing everything you started with because of the fees. Again, pay attention to this. You're not giving away 2% of your earnings, of your return on your investment. You're giving away 2% of everything you invested every year. So while you cannot count on your mutual fund going up nicely every year, you can definitely count on the fund managers taking their fees like a clockwork, right? This is especially bad when things are not going great on the stock market, which is the nature of the stock market. It goes up and it goes down. If the stock market is flat 1 year, you will lose 2,000 on your 100,000 investment. So the question is, why do these high fee funds exist? If they waste so much of your money, why do they exist? The friendly salesperson in front of you will tell you that their fund is special. They charge a 2% fee because they have the brightest investment team working diligently to maximize your investment. For a small fee of 2%, small management fee of 2%, you will get the best team and their expertise. And they will likely even have some charts showing you why it's so great. That's well worth the fee, right? Historically speaking, it's not the case. And don't take my word for this. You can read the reports from Standard & Poor's about mutual funds performance, and it's not a pretty picture. So now you know why banks are biased when they sell you mutual funds, why most mutual funds are bad investment vehicles, in my opinion, why you're giving away a lot of money when you use mutual funds. Okay, enough talking about the problem. In my next mini training episode of the Wealth Building Tips and Strategies, I will share with you the solution to this problem because If there is a problem, there is a solution, right? So join me next Wednesday at 10 o'clock Eastern, where I will show you how you can get around paying these crazy fees while still investing in diversified financial instruments. And if you want to learn more about investing your money so it starts working for you, email me. Email me at millen@daretochange.life.com. In the meantime, join my private Facebook group, Wealth Building for Powerful Women, where you can ask questions, you can share your ideas, you can get some tips about creating lasting wealth, making money, keeping money, and growing money. Thank you for tuning in today. Until next time, be wise with your money. Grow your wealth, live on your terms.